A nation in free fall. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the stunning collapse of a once mighty nation, and I'm going to show you why it's too late to stop it and why many other economies are going to follow it down. Plus, we have a sponsor for today's show. You might remember QU Media. Well, they're back, and they've got some big news they announced recently, and you can find them on the TSXV under the symbol QUV and on the OTCQB on the symbol QUF. And on the back of this big news and what we're seeing in the charts, I want to show you why we think their stock could go up as much as 33%, and based on the news, could break out even higher. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with a headline: Chinese-style quantitative easing emerges as property fix option. And I want you to take you back to when we did quantitative easing. We were right in the middle of the global financial crisis when Ben Bernanke came out with the first of 3 iterations of QE. Of course, we know there have been somewhat soft versions after that, but this is crisis era policy now being implemented by China. The question is, what are they doing and why are they so desperate? Bloomberg News reported that the People's Bank of China may provide at least 1 trillion yuan, or about 140 billion of low-cost funding to construction projects via its pledge supplemental lending. Now remember, central bankers love to give things names that people don't understand. In this case, we have the pledge supplemental lending program that the central bank has provided cheap long-term cash to policy banks by accepting their loans as collateral to fund lending the housing and infrastructure sectors. Now, you remember what QE actually did is the banks who were buying U.S. Treasury securities and mortgage-backed securities, the Federal Reserve came in and they did an asset swap. They bought those securities and they gave them a reserve asset, which effectively looked like cash. So what we're seeing now out of the People's Bank of China is a QE-like operation, which is just staggering because it tells us that the state of their property sector and banking sector are far worse than even we thought. Unlike QE programs undertaken by the Federal Reserve and others that involve large-scale bond buying to push down yields, China's version is more targeted specifically at the property sector. The PSL was used between 2014 and 2019 to help fund a home building spree, leading some economists to describe it as Chinese-style QE because the resulting creation of money. Now, I want to stop there because QE did not create money, and this doesn't create it either because this all stems back on the banks. The banks will have to originate loans to the developers, and then you're going to see the People's Bank of China step in and buy that debt or swap it for cash. Now, why that move makes a lot of sense is because what have we been talking about on recent shows that the Chinese banking sector is desperate for? They're desperate for cash. This is how we're going to see the PBOC get cash into the hands of the banks without creating any money. And of course, this will lead to the expansion of the central bank's balance sheet, and with any hope, it's going to be a revival to the real estate market, but I don't think it's going to work at all. And developers are facing increasing liquidity pressure as funding from loans and sales dry up. They need 18.9 trillion yuan in 2023 alone to repay short-term liabilities. So now you remember, we go back here a couple of days, and what did we see? China said, we're going to force the banks to lend to the listed property developers, that we're going to give it because we know these developers need money. The problem is the banks don't want to do these unsecured loans. And what do the banks want? Well, they want cash, so everybody's a winner here, all on the back of the PBOC injecting what appears to be cheap money. It's just cheap loans into the economy. And they need this money to finish pre-sold homes. The funding gap, which is equivalent to a whopping 15% of GDP, will be a similar size in 2024. You can only imagine that this program will continue then. So here we're seeing the collapse of China's economy, but they're not the big one that we're worried about today. But let's first take a look at what's going on in the U.S., because it seems to be that we've engineered the soft landing. The question really should be, is it just an aberration in the data, and are we about to see another big downturn? Well, we're going to make the case of why we are. The U.S. economy grew at 5.2% in the third quarter, more than first estimated. And this will put policymakers and political elites in a very excitable position because they're going to boast about how the labor market stayed intact despite the fact that we have now sky-high interest rates, we have quantitative tightening in place, and that, yes, Americans should be happy that the economy is booming. And yet one thing we continue to hear over and over is that Americans are not happy because we know that their total compensation continues to fall behind inflation. So despite the fact that we're seeing the U.S. economy growing, one of the challenges is a very few percentage of the people are actually benefiting. The downward revision to household outlays reflected slower growth in services spending, which is not supposed to happen. Remember, we heard services was going to boom and pull manufacturing up. We said the opposite will happen. Manufacturing will drag services down. And sure enough, that's what we see. And after a previously reported decline, business investment was revised up to a gain on the back of firmer outlays for structures. Housing was also stronger than initially expected. And that, of course, means us the question: where is the U.S. economy going? Is this indeed the soft landing? Well, it appears to look like that, but this actually happens in the past. Let me show you, because what we're also seeing is not just kind of a last hoorah of the economy. You're kind of seeing the last of all the pandemic money, last of the ability for consumers to go out and borrow money from the banks, really get injected into the economy. And the evidence is we have the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes. This shown in blue. Anytime the blue line is above that horizontal black line, it means on net banks are tightening standards. And what that means is they're simply making it harder for you and I and everyone else to get a loan. And in a debt-based economy, when you make it difficult for people to borrow money, you have less money being created in the economy, because that is what commercial banks do. So when you slow down the credit creation mechanism in the economy, the natural effect is at some point with a lag. And again, this isn't something we can measure because you have to base on how tight the banks constrict credit, plus the factor of how much money that's from the pandemic stimulus is still in the economy. But look what happens now. If we overlay real gross domestic product in red, this shown on a year-over-year rate of change, it's not unusual heading into a slowdown or recession. You get a little bump in the data. Here you can see it going into the dot-com bubble. As banks were tightening standards, the economy was still growing. And you kind of see it here going into the global financial crisis. Banks had just started tightening standards, and there was a little bump in the data before it rolled over and headed down. In fact, even into the pandemic, against the point where the Fed had, remember, they were easing going into the pandemic before we even knew there was a pandemic. And what happened? We get a kind of transitory bump in GDP growth before it goes falling off a cliff. And now what you're going to see is, again, these policymakers and political elites are going to boast about how they've done the impossible. And based on the fact that we see the banks continuing to keep credit conditions tight, we know the consumers are tapped out of money. We're seeing that, and of course, in the fallout data from Black Friday and Cyber Monday, it tells us the next direction for the U.S. economy isn't higher. It's actually lower. Meanwhile, economists see stubborn U.S. core inflation keeping rates higher here in the U.S., as we're going to look and see why, as other countries' economies are headed down, dragging interest rates even further to the downside amid a time when no one thinks that's going to happen. The recent slowing in inflation, employment growth, and consumer spending supports our call the Fed is done raising rates. So as we now kind of look at that GDP data, we can say, wait a minute, it does appear to be transitory, because we're starting to hear other experts suggest that indeed the U.S. economy is slowing. When that happens, real GDP will indeed head down. However, given inflation remains still high and will decline just gradually, well, that is because we're talking about the core CPI. When you exclude food and energy, it does decline gradually. It doesn't generally move quickly. The Fed will wait to cut rates until mid-2024, and the easing of policy will be gradual. I could not disagree with that more. While I do agree that the core CPI does go down gradually, it has nothing, absolutely nothing to do with Fed policy, other than the fact that the Fed wants us to believe it. And we hear Fed Chair Powell come out and say, well, we care about the core CPI. We're going to hear about that in a couple of weeks at the next meeting that they have scheduled for December. But in reality, they don't care about the core CPI at all. And here's the evidence. We have the federal funds rate in blue against the core CPI in red. Now, the core CPI shown on a year-over-year rate change. And here you can see the Fed cutting rates as the core CPI went up, going out in the late 80s into the early 90s. How about we fast forward to the dot-com bubble? Well, the Fed wasn't focused on the core CPI then because, well, they were cutting rates as it was rising. And then again, you look at going into the global financial crisis, what happens? The Fed's cutting rates. Core CPI is just, it's going horizontal. It's going flat line. It's not going anywhere. And yet the Fed's cutting. How about into the pandemic? Remember, the Fed was cutting rates as the global economy was slowing down. Sure enough, the core CPI was headed higher. Now they think it's all that matters, but no, it does not make a difference at all. But we do know that inflation in the U.S. is coming down, and that is a big sign of demand going away and evaporating. It is an indication that U.S. economy is indeed slowing, but not as fast as a pace as China. And if you're wondering what we're doing in front of the Bundesbank today, well, that's where we're headed. It's next to show you why that one major economy is in free fall and they can't stop it. But let's take a look at what's going on further here in the U.S. because West Texas Intermediate extends losses after across-the-board inventory builds. Now, when you hear the word inventory builds, you should be thinking demand is going down, and indeed, that's what's happening in a big way. As we look at the Department of Energy data, we see crude up 1.6 million barrels over the last week. Cushing inventories up 1.85 million, but that's not the issue. Look at gasoline inventories up 1.76 million barrels. That tells you that demand for gasoline is falling, even though prices are coming down. And that should tell you consumers have less money. But how about this? Distillates. Now, this goes into jet fuel. You look at this, 5.2 million barrel bill. That is outrageously large. And if you think about what this means for inflation, well, it means inflation is indeed coming down in a big way because U.S. consumers, and we're starting to see more evidences, are tapped out. And it's not going to be just one nation in free fall as they start to shot. It's going to be a whole lot of them. Let's take a look at where the CPI is headed as we look forward to the December data. This, we have the federal funds rate. Again, the Fed says they make policy based on the consumer price index. Well, they don't actually do that. Here you can see the consumer price index heading higher back in the late 80s, early 90s as the Fed's cutting rates. Here again, you look at it back going to the dot-com bubble. The Fed had started cutting rates and CPI had just plateaued here. It's more of a reaction to something else that we'll show you here in a bit. And how about going into the global financial crisis? Well, if inflation mattered, the Fed should have kept rates tight, but they didn't because the banking system was headed into a collapse along with the rest of the economy. Same too here going into the pandemic. And now the Fed says inflation needs to get down to their 2% target. Well, it's going to go way beyond their 2% target. The real question is, what is driving Fed policy? Was everything to do with the bond market. And all of a sudden, global bonds are headed for the best months since 2008 financial crisis, suggesting that what we're seeing, not only in China, but what we're going to show you is going on in Germany, and we're starting to see in the U.S., is a global slowdown. And remember, what's key about bond yields is they tell you where growth and inflation expectations are headed. So if you see yields are falling, despite the fact that everyone's selling bonds and short bonds and no one wants to own them, it's because none of that stuff matters. In a debt-based economy, when growth slows and inflation slows, in order to sustain asset prices, you need the creation of new money. And there's only one mechanism to do that, is to get people to borrow. And by design of the system, rates will naturally just fall, telling us we're headed into another crisis. And that's exactly what is coming. Fed Governor Christopher Waller helped bolster rate cut bets on Tuesday when he said the current level of policy looks well positioned to slow the economy and bring down inflation after, of course, many of them said that we needed to get tighter and not too long ago. And some investors who will talk more about billionaire Bill Ackman says the easing will start even earlier than traders anticipate. And Bill, I agree with you completely. Waller's been a hawkish, tilting member, so for him to sound dovish has been significant. This from a senior portfolio manager. It sounds like the Fed is all but done in their hiking cycle. The reality is the Fed has gone too big and too far. They've inverted the money curves by far too much, and they've done it for too long. And the longer you constrict credit in a debt-based economy, the more likely you're headed not only to a recession, but an all-out financial crisis, perhaps something worse. Because the problem is we had a synchronized expansion out of the pandemic. We have synchronized policy since the pandemic, and now we're seeing synchronized slowdown. But let's take a deeper look. Because really, interest rates are a function of the economy, nothing to do with what people are trading them. Here we look at the current general business activity for the Philly Fed, that's shown in blue, and if we have the yield of 10-year Treasury securities, that's shown in red. And what do you notice? When the economy slows down, we see the manufacturing slow down, what eventually happens? Yields go down to spur growth. That's the key, is yields just naturally fall. It doesn't matter who's trading them because the system is just designed to work that way. And you see over and over in cases where manufacturing sector slows down, rates fall. Even in some places I didn't highlight it here, but I just want you to see the notable trend is why rates continue to fall. This is one of the few times we saw the manufacturing sector decline amid everybody trying to short and drive yields higher. Of course, we noted this would be a transitory effect in the big picture of things because, again, in a debt-based economy, you need the creation of new money to support growth and asset prices. Without it, the growth ends and asset prices come crashing down. That's why interest rates just naturally fall against whatever expectations the world might have for them. And this means the Treasury melt-up grows as bond traders price Fed cut by May. Of course, doesn't matter. I think it's happening even sooner as expectations for the path of Fed's policy rates have been shifting downward based on indications that the U.S. economic growth is decelerating from its third quarter pace. And billionaire Bill Ackman has entered the debate of when that's going to happen, saying perhaps as soon as the first quarter. And sure enough, if you want to know what really drives Fed policy, well, take a look at the 2-year Treasury yield against the federal funds rate. And here's what we do know, and this is why we're going to see central bankers get nervous, because anytime the 2-year Treasury yield shown in red starts falling ahead of the federal funds rate, well, that's where the Fed plays chase. It has nothing to do with the consumer price index, nothing to do with the core CPI or any of the other things the Fed tells us. Has everything to do with market expectations. In one place, expectations are tumbling. And I want to show you why they cannot stop the collapse of this once mighty nation, because it's happening now right before our eyes. As German inflation sinks more than expected as energy retreats. Remember, inflation is not just a function of price, it's a function of demand. And so when demand evaporates, prices start to fall, or the growth of those prices, more importantly here, start to slow down in a big way. And that's exactly what's happening in Germany. We knew this was coming. As consumer prices rose 2.3% from a year ago, down from 3% in October and less than the 2.5% expected. They fell 0.7% on the month. That is deflation. That is an economy in contraction, my friends, with package tours alone responsible for 0.15 percentage points of the decline. And what that tells us is we know where the U.S. economy is headed in terms of why we're going to see deflation here, why that's a likely case, because when we come back and look at the net percentage of domestic makes tightening standards for commercial industrial loans to firms of all sizes against the consumer price index, we'll use this as a proxy for what's going on in Germany. When you constrict the creation of credit, at some point it backfeeds into the economy, demand goes away, and you see the consumer price index come tumbling down. Below that horizontal green line, that's where you get deflation. We're not there yet in Germany, but it's telling you when that happens, and it's likely to across all these major economies, we're going to see deflation, and that means we're going to see the collapse of not just one big country, but many, because that is what happens when central bankers constrict the creation of money and hold it there too long. And at this point, even if they did cut rates in a big way, it's too late. There are lags, big ones. And in Germany, the Bundesbank president has warned against letting up on inflation fight too soon. And just like a true central banker, they're going to do the opposite of what they should do and drag this out too long until we have an all-out crisis, as officials can't assume that price pressures will continue easing as rapidly as they have been during the past year. But one thing I do agree with is billionaire Bill Ackman said there's a real risk of a hard landing if the Fed doesn't start cutting rates pretty soon, and that is a stark reality of what is to come, is we're going to see major problems here in global economies. But does that mean there's still opportunities to make money in the markets? Well, it certainly does, and we think QU Media, our sponsor of today's show, is one of those opportunities. Now, you may remember we featured them before. Well, they're back with some big news news. Again, everything's in the description and pinned comment below. Let's take a look at what their announcement was that came earlier this month. And again, you can find them on the TSXV under QU.V or on the OTCQB under the symbol QUF. We'll take a look at their stock here in a moment, as we like to do, but QU appoints former TikTok country manager Raj Mishra as India Group CEO. This is a big deal. This guy is a big hitter. He has the experience to take QU Media to places, well, only it could dream of, because this guy, he's got the experience, he's got it all. And what we can see, Raj has joined the company effective immediately as the group CEO as QU Media's India operations, overseeing all business units. He's going to focus on increasing operational and financial synergies and strength among the three primary business units as the company further pivots in India into digital distribution and direct consumer initiatives. And when you have a guy like Raj show up in your company and start to take the helm, well, he's going to attract, because of his track record and his past successes, he's going to attract a lot of other money and investors, and that's why we want to bring them to you first. Let's take a look at where we think their stock price is headed. It's currently trading right around 6 cents a share at the time of record, somewhere maybe even in the high 5 cents a share. And our target here is upwards of 8 cents on that first move. That would be about a 33% move to the upside. And I want to just point out that we've got these supply zones. You see this upper one between these horizontal purple lines and the lower one down here. This is where the sellers are at, up here around that 8 cent level. Buyers are here down around that 4 to 5 cent. And what you can see is the volume profile line is right there at 6 cents. So what does that tell you? The sellers and the buyers are duking it out right at that price level. And you can see this beautiful bottom starting to form out. And once those sellers are exhausted, that sets the catalyst of that 33% move to the upside. And we think Raj's membership of the company, by taking over the role of the CEO of the India unit, could be the catalyst to do that. Now, here's what the co-founder and media CEO Kurt Marvis had to say. Now, I got to speak with him personally, and he had a lot of great things to say about Raj. He says Raj's understanding and knowledge of how the creator economy works as a result of his roles at both musical.ly and TikTok are invaluable for us as we build a creator-centric brand and business. His appointment to oversee our entire operation in India launches a very exciting new chapter in our history, and I can imagine it's going to attract some big investment dollars. You bring in big hitters like Raj, and they bring people with them. And let's tell you where their stock price. Let's zoom in to the 90-day chart. Here again, you see that volume profile line right at 6 cents a share. You see a stock trading right at about that level. There's our catalyst. We think this stock, once it breaks through their sellers, heads up to 8 cents a share, and that's why we wanted to bring it to you, of course, ahead of what anything could come. Keep an eye out for all the news you can on this company. I think big things are happening. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.